President Trump's steep tariffs forming a challenging landscape for the central bank. Fed officials left with the crucial task of working out the impact of tariffs on inflation. Meanwhile, the path for interest rates remains uncertain. University of Pennsylvania adjunct professor of finance and former president of the Federal Reserve Bank of Cleveland, Loretta Mester, joins us now with a closer look. Loretta, good to see you. First and foremost, Loretta, I want to get your take on Liberation Day. What did you make of these new tariffs, Loretta? What do you think the Fed makes of them?
Well, thanks for having me on. The tariffs are going to affect both parts of the Fed's mandate, full employment, maximum employment, and inflation. And it's going to affect both parts over different time horizons. So that's what makes this particularly difficult for the Fed. We know that tariffs act like a tax, so it's going to reduce growth and weigh on the growth side, which means the employment side of the mandate. And then, of course, it will have at least a temporary effect on inflation. The question of whether it will be more meaningful in terms of inflation, more persistence, is really going to depend on, firstly, whether there is a lot of retaliation and then back and forth and tit for tat, which means that instead of being one shock, it's multiple shocks, kind of like what we saw with the supply shocks during the pandemic. But also crucially on whether inflation expectations remain anchored at levels consistent with 2%. 2% inflation. And that is probably a question at this point, because we've already seen some of the inflation expectation measures move up. If inflation becomes embedded and people see higher prices because of the impact of the tariffs, they may start believing that inflation is moving back up again, even though it's come down quite a bit from the peak. And therefore, it can become a more persistent inflation problem. We didn't see that under the first Trump administration. In fact, inflation remained low, didn't move up. And what the Fed ended up doing is having to address a weaker growth economy, and therefore started cutting rates in September of that year, so in 2019. So again, we don't really know how this is going to play out, but I think there's higher risks this time that the tariffs could be inflationary, and that's something the Fed's going to have to keep in mind in balancing both parts of the mandate.
Loretta, the market seems to be of the mindset that the Fed is on hold for a little bit longer, probably not going to cut rates again in May. Jerome Powell, though, to the surprise of, I think, a lot of many market observers, brought back the transitory word when describing inflation at the last press conference. Do you feel that some of these pressures that we might see from tariffs are in fact inflationary, that the Fed could be pausing but leaning more to the dovish side of wanting to cut again? Or are you worried that prices are going to remain stubbornly higher for longer?
Yeah. I mean, even before the tariffs, there were signs that inflation was remaining a little more stubborn than the committee would like, which is why they paused in January. So if you couple that with now this potentially, inflationary shock from the tariffs, I think there's upside risk to the inflation forecast. Now, of course, they'd like to be able to look through the one-of tariff impact on prices. I mean, typically what the textbook would say, you have tariffs, prices move up, and then inflation moves up temporarily, and as those prices work through to when there's a new level of prices and inflation comes back down. I don't think they should put all their money on that bet. I think they should be very carefully looking, and I think the chair said this, at inflation expectations, because if they become unanchored, then you have the worst case scenario where you have weak growth and you have inflation moving up, or at least not coming down. So I think they are going to be, being on hold, if you will, but that's really about balancing the risk, right? They're trying to balance the risk of inflation pressures moving up at the same time the economy weakening. And so being on hold at where the rate is now until they're convinced that inflation expectations are well anchored, and then being ready to address a potential deterioration in the labor market seems like a good strategy. The danger with the strategy has to do with how that's communicated, because it could end up being communicated as, see, the Fed was late again, they remained on hold too long, and therefore now they're cutting, but they should have cut earlier. But no, it's really a strategy to balance those risks, to make sure that inflation doesn't get out of hand. And I'm hoping that they begin to communicate more about the objective function and their their objectives and reaction function, so that people will understand why they're following a wait and see. It's not because they're asleep. It's just they're really trying to balance what's going on between the real side of the economy, employment, which is part of their mandate, and inflation, which is a very important part of their mandate as well.
Loretta, I'm just curious, how would you characterize the state, the health of the American consumer right now, Loretta? Because I mean, you've seen the recent sentiment surveys, not good, Loretta, and that was before Liberation Day. So how would you characterize it? How are you thinking about it?
Yeah, I think the consumer is nervous. I mean, I think, as a lot of people are, about what's next. And, there's a lot of uncertainty, and there was even before we knew what the tariffs were, there was so much back and forth on the policies that the uncertainty around it just makes everyone pause and just say, okay, I better not spend a lot of money now because I don't know what's coming next. I better be cautious. And add to that, the uncertainty over the DOGE cuts and what does that mean? There's a lot of people affected by that, not only federal workers, but people who, work with the federal workers. Universities are affected because their funding is getting cut. So there's a lot going on in terms of the policies here. And even though there's some, there was some kind of hope at the beginning of the year that we'd see the deregulation and, being positive for growth and perhaps tax cuts being positive. I think the uncertainty around the current policies and the tariffs have really, reduced sentiment. We started out the year with very high levels of sentiment, certainly after the election, and now we're seeing very low levels. And so I think the consumers are rightly, sort of let's pause a little bit on discretionary spending and let's wait and see, how, healthy the economy is before moving on. And you talk to businesses and they say the same thing. All the businesses I used to talk to and now continue to talk to tell me the same thing, which is just tell me what the rules of the game are. I can play the game. I can run my business, but if I don't know what the rules of the game are, then I'm going to have trouble and I'm going to be on pause. And that's what businesses are doing now. They're pausing some of their projects because they don't really know what's coming. And so that's how this can, not only the tariffs direct effect, but the uncertainty around policies coming can affect the economy in a negative way. And I think that's what we're living through right now.
Loretta, great to have you on the show today. Thanks so much for your time.
Thanks for having me.